Private Equity é uma modalidade de investimento que está crescendo no país. Mas o que exatamente é Private Equity? São fundos que investem em companhias inovadoras com grande potencial de crescimento. Depois, trabalham com essas empresas para expandir ou melhorar seus negócios. Em troca, adquirem uma participação nesses empreendimentos. Este capital vem de grandes investidores institucionais, profissionais, endowments, dos próprios gestores, de instituições multilaterais, bancos de desenvolvimento e é organizado em um fundo fechado e regulamentado. Depois de alguns anos, 3 a 8 de trabalho intenso, o fundo vai buscar sair da companhia, seja tornando uma empresa aberta em bolsa de valores ou vendendo a sua participação. Assim, com a venda, o dinheiro é devolvido aos investidores com lucros e à equipe pelo seu trabalho. Como resultado, os investimentos em Private Equity geram mais e melhores empregos, empresas mais produtivas e sustentáveis e contribuem para o aprimoramento das condições de vida da população das cidades e bairros em que estão inseridas. Assim, os fundos de Private Equity promovem o crescimento das empresas e seu desenvolvimento sustentável. Investem bilhões de reais todos os anos em companhias de diversos setores do Brasil. Incentivam e apoiam o desenvolvimento de inovações que melhoram a vida das pessoas, a mobilidade das cidades, incrementam a produtividade e simplificam o cotidiano. Transformam a vida das comunidades em que estão inseridas, trabalhando com responsabilidade social e ambiental. E ainda geram empregos, renda, riqueza e impostos para o país.
Bom dia, galera. Bom dia a todo mundo. Seja bem-vindo. Welcome to the GP International Fundraising Bootcamp, put together by ABVCAP, together with Apex Brazil, as part of our Convenio program, which is part of a series of events and a series of functionalities that we've had over the past, shall we say, 6 years. I'm going to talk a little bit about that now. And we'll put together some information for you concerning the events that we're going to be having here over the next few days. So here we are, the In Brazil program, private equity venture capital. A lot of you have participated in over the past few years, but effectively it is a series of events and a series of initiatives held together with Apex Brazil in order to try and to help GPs connect with LPs on a global basis. Over the years, we've seen 49 funds have been part of the program, raised over close to $20 billion over a period of almost 10 years. And a lot of investors have been tracked through the program. Today, as part of the program for the bootcamp, we're going to be hearing from speakers that will be involving with data mining, LP discovery. We'll be talking about offshore structures, GP positioning, content, marketing strategies. We're going to be having LPs talk about their cases and what they see and what they don't want to be seeing in terms of fundraising, as well as placement agent and placement agent input in terms of the whole process. To get us kicked off, though, and to talk a little bit about the perspective before we run into the actual the stories that we will start on off with pre-Ken, wanted to give you just a quick introduction of what the international market is seeing in terms of fundraising and fundraising flows for emerging markets and also coming outside of Brazil. The big picture is the private equity industry and the venture capital industry is robust. We've seen growth since 2016, around $2.5 trillion, up to current levels of close to $5 trillion. But we're expecting to see further growth coming into 2025. Expectations for LPs and their demand is also very strong as well. We're the only one of these categories that's actually seen a reduction in interest has been hedge funds, but all the private equity, infrastructure, real estate, alternative assets have all been seeing LPs putting up more rather than less. And with this increase in fundraising, we haven't seen a equivalent level coming out of Latin America. This has been a very much more of a focus on multi-regional and North American funds and less in emerging markets. Latin America, this is from the most recent Cola Capital Global Barometer, which was out last week, in fact. But you can see there's been a significant reduction in demand for interest and changes for the aspect of Latin America. And you can see from the respondents, these are from the main money source areas being North America, Europe, and Asia, which is where we see over 90% of the capital demand for the region. Things are not getting easier on a destination basis, but even more so in terms of numbers of competition in the market. We're seeing increased competition for GPs getting on the road, traveling the world, wanting to go around and find international money. More and more are on the road. We can almost have 3 times as many GPs are on the road now as what we had back in January of 2015. So, and the size of funds that they're looking to raise are also larger and larger, which provides its own difficulties as well. Now, one of the worst parts for us right now, and the thing that we have to consider with the international market, and this is from a placement agent group, Eaton Partners had a survey back towards the end of last year, where they felt the best capital market opportunities were for a series of LPs that they were speaking to. This is clearly an exaggeration. This is clearly a reflection of the moment, but it's important that we categorize ourselves as not just inside an emerging market, but in a new category that's being classified as someplace else, which is making things difficult, but it's something that we have to work with when we're looking at international strategies. So the spotlight has been very much turned away from us, and probably the highest level we had was maybe back in 2011. But since then, for some aspects that are to do with domestic policy, to do with international conditions, and also the way that the private equity market has increased in size and focused more on itself and on the main US and European markets, it's still, in summary, this could well be a moment for us to show a low FOMO, which is a lack of fear of missing out for the Brazilian market. So this is what we have to deal with, and what we are trying to address with some aspects of this fundraising bootcamp is to try and make our situation that much stronger so we can keep ourselves in line with expectations and understand the length of time it's going to take, the amount of effort, and the amount of attention to detail and tactics that we will have to put together to have international fundraising success. And these, these would be considered our summary of this. We are looking to see LPs continue to increase their size of commitments. The commitments are going to continue to be more on US and European focus. We're expecting that, and we're seeing an extension of this low FOMO moment. So this is where we stand. This is where we'd like to see ourselves move on from. But yes, we're going to be spending a lot of time fundraising over the next few years, and it's going to be a continued hard battle where we need to have as much information as possible and as much tactical and strategic help as we can get. So that's the focus for the boot camp. We're going to be looking to put together a number of important strategic and tactical elements for you as GPs. Please feel very comfortable with putting in questions during the entire session. It's going to be 2.5 hours packed full of interesting content. And so to kick us off and to put us into fast forward mode, let's go over to Amy Benstead, who is kind enough to come in from Prekin, and she'll be talking about using digital and data services online from the Prekin suite of products.
Thank you for the introduction, Robert. Would it be possible if I could share my screen? Thank you.
I believe so, yeah.
Yeah, thank you very much for having me.
I hope you will.
Well, hopefully, let's give it a go. Thank you very much for having me. It's a real pleasure to be invited along to the boot camp and to help share some insights on Preqin and how we can help you raise money from international investors. I'm going to spend just a couple of minutes, just a bit of an overview of Preqin and who we are and how we can help. But the meat and bones of my session today will be for me to actually give you a live demo of the Preqin platform to really show how you can interrogate our platform and our data to find potential LPs for your fundraise. A bit about Preqin. We've been around since the early 2000s. We track everything alternative, and we are the world's leading provider of alternative asset data. So when we think about alternatives, we're thinking about everything from private equity and venture capital through real assets, private debt, and on the more liquid end, hedge funds. And when we think about data, we also think about everything. So we track information on investors, which I'll be spending a lot of time talking about today, but we track everything else around that. So we track the funds that are in market, the commitments that they've made, the performance of those funds, the companies that those funds have invested in, really to give the most complete picture of the alternative asset world that we can give in order to help customers, be it GPs for fundraising, LPs for fund sourcing, or service providers for business development. We've got a large and diverse customer base. I'm based here in London, but we have offices across the globe. We're currently servicing over 150,000 users of our platform. And the Preqin team is about 800 strong, and nearly half of those are all in our research team. So these are researchers who are the people that are going out and gathering that data, verifying that data, and making sure that the data that we're putting out to you is accurate and insightful, and really importantly to us, is often exclusive to us. So a key kind of selling point of Preqin has been that we have grown very significant relationships with the LP community over the last 2 decades, and many LPs are our customers as well. So what we're able to do by having a very deep bench of researchers is establish relationships with LPs. So we are finding out information that's not elsewhere, not publicly available, and that helps to give our GP customers unique and actionable insight into how to approach LPs and what they're actually thinking and feeling at any one time. So before I just get into the demo aspect of the session, I just wanted to share with you a bit about one of the key ways that we can help GPs around their fundraising. And what we know as a data provider, we've got all the data at our fingertips, is that our customers raise both more money and they raise that capital faster. So funds that use Preqin's data raise 1.5 times more capital than all other funds in the market. And they are also able to close those funds sooner. So to the point that Robert made earlier, you're working in an environment which is challenging. If fundraising's taken a long time, you are going to be spending a lot of time on the fundraise. A service like Preqin can really help you with that by giving you unique and actionable insight into LPs, particularly LPs you may not have considered before, to help you when you are going out and selling yourself to those funds. With that in mind, I will now start a live demo of the Preqin platform in order to help you be able to understand better how Preqin can help with your fundraise. And to bear with me 1 second, any technical issues. You're now looking at the Preqin website. So this is Preqin Pro. This is the home of our alternative asset data. And this is where our clients come to in order to be able to find information on the LPs that they're going to be trying to sell their fund to. There's lots of different tools. There's lots of different functionality on the platform that can help GPs. There's lots of different data sets. I'll be spending all of my time focused just on our LP data set, and specifically a few searches that we think will really help you if you're trying to go after those international LPs, as well as showing you an in-depth profile that we track on the LP client base in order to help you understand how our data can work for you to help you position your fund and ultimately to connect with the right people at these LP groups. So the first thing I'm going to start with is just to run you through some of our more advanced searching capability. So you're now looking at a pre-con advanced search. We track around 15,000 institutional investors that are actively investing in one or more alternative assets. And whilst this is a great big number, one of those LPs is going to help every single fund manager out there. It's also a lot for you to get through. You're not going to be able to pick up the phone and speak to 15,000 LPs. So what we do for our advanced screening is we help you to get to the group of LPs that are more likely to be interested in your strategy. And I'll be talking you through specifically 3 different ways of doing that, but we do have multiple searches which can help you get to those LPs. If you look at the left-hand nav of our website, you can see these are all the various searches we have. We have different searches for fund managers, funds and companies. Our GP clients are using all of these in lots of different ways. So for instance, a key part of fundraising is understanding who your competitors are. So we find a lot of our GP clients will start with running a screen for fund managers or funds that might also be in market. Another reason GP customers are using us is to find potential companies to invest in or to find potential fund managers to exit companies to. So they'll be using our companies and our deal screens as well to achieve that. But as I mentioned, I'll just be focusing today on how we can help with finding international LPs for your funds. The best place to start is to really drill down into LPs that are more likely to be active in your strategy. So say, for instance, you run a VC fund and you are looking to raise money internationally. You might then be looking for investors who are active in all regions except for LATAM. You also want to find investors that are actively interested in the LATAM region. So based on all of our understanding of our customers, we have these advanced screens, which allows you to really drill down into LPs that are just of interest to your strategy. So with this query, I have now built up a list of LPs that are outside of the LATAM region and are specifically looking to invest within the LATAM region. And they are also looking for VC. And you can then go and build and build and build on this query. So say, for instance, you work in a specific sector, you may be an energy specialist, or you can then drill down into the LPs that we know specifically, just like that sector, just like the energy sector. And you would end up with a list of results of LPs that match that search that we've put in place. And from here, you can do lots of good stuff. So the number one thing I recommend that all our clients do is that you create a target list of these LPs. But if you do that, you can then get notified anytime we've got any update on those LPs. And that may be that we've found some new data on it. It may be that there's some interesting news about that investor. Perhaps they're making a new investment. You can also export all of this data into Excel. Our customers find it incredibly valuable because you can do lots of good stuff, like get access to all of the contacts associated with those investors. You can do some analysis on what does that investor universe look like. And you can also use that to get that into your own systems to do your own analytics or just to simply work through that list. The key thing to note here is the depth of the data that we have. So in that export that you can make from the list, you can get access to over 300 certain data points on LPs. And that is across all the various asset classes that we track, but also specific pieces of information around that. This is our first advanced search. This is often where our customers start when they want to get a view of the landscape of who are the potential LPs that could invest in my strategy. There are, I'd say, 3 other searches which are really, really helpful, particularly for an audience like this, which will get you more focused and specific lists of LPs. So the first will be our fund searches and mandates. This is really similar to our advanced search, but this is based just on LPs where we know they're putting money at work in the next 12 months, and it will bring you back results based on those mandates, based on those searches. The second one I would show you would be by fund manager and fund. And I think this is a really, really powerful search, which enables you to tap into the power of Preqin's data, which is basically connecting various data sets. So as well as tracking 15,000 or so LPs, we track millions of commitments that those LPs have made. So for instance, if there's a specific competitor or a specific fund manager that you know that your strategy is like, you can find LPs that have already invested into that fund manager itself. So in this example here, looking for a LATAM-based GP. And it will return all of the LPs that we know have invested in that fund manager. So around 22 LPs. And these may be good first ports of calls to start fundraising from, because we know they've already invested in a fund that looks like you. The really, really powerful search is our by past investment search. So this essentially connects the dots between all of these millions of commitments we've made and the LPs into those funds. So you can really find LPs of very specific matches to your sorts of requirements. This is basically, I like to call it, investors putting their money where their mouth is. So this is return your investors based on the actual fund commitments that they've made. So for instance, if you're looking for investors in sort of LATAM strategies, and you want to look for investors out of the LATAM region, you can quite simply build up a query of all LPs that have invested in LATAM-based funds, but are not based in that region itself. And then you come up with a smaller list of LPs based on that. And then you can actually go in and see, well, what are those fund commitments that they've made into these products which look like that. And then you can do some more diligence on it. So really the way that Pro works is to get you to lists of LPs that we think are going to be the most likely to consider your fund. And then once you've done that, essentially that's where you begin to do a deep dive into the profile of that investor itself. This is where our clients will spend a lot of their time. We'll be looking at the actual in-depth profiles of these LPs to build up a picture of, are they going to invest in me or not? So in this case, I'm looking at CPP Investment Board, probably a scheme that we've all heard of before, one of the largest LPs in the world. But we've reached this profile because we know they've got a lot of activity in the LATAM region. So what our customers typically do from this point would be to begin to build up a picture of, why should I care about this LP? Should I care about this LP? And then how do I actually sell myself to the LP? So,
perfect. Amy, let me jump in for a second there. I haven't had any questions coming in from the audience. It's very, very intriguing. The depth of the Preqin platform, I know personally from having used it for over 10 years, is quite astounding. There's an awful lot of good information deeper down into it. And I know you could spend a half hour to an hour doing this easily, just about the functionality just for us in Latin America, looking specifically. But just to let everyone know that all of your information is also going to be put into the program and the platform, that people can click on the in-event screens for all of the background information from Preqin. Amy obviously will be available for additional discussions. If you want to set up a meeting with Amy on the in-event platform, that will be available as well. She will have access to that over the next couple of days, so you can hook in for more of a direct demo. There's a tremendous amount of information that can be pulled up from this. The cross matching between interests and past history is critical, and it provides a tremendous amount of information that we can't just get unless you get on the plane and go over and knock on the door and talk to them in person. And so, Amy, I just want to say thank you for your time for this, and we appreciate you giving us an overview of the Preqin. But again, just for everyone to remember that she is accessible through the in-event platform for you to set up a meeting with her and to get a straight up conversation. And she's very interested in talking to each and every one of the 50 participants which are out there today that are looking towards ways of generating data and information. So Amy, again, thank you for your time. Appreciate you being here with us, and I know that you'll be available and around for the participants. So yeah. The next segment we want to get into is talking more in terms of some of the legal structures and the offshore structures that are being used currently in both private equity and venture capital formats. A lot of you have already heard about and are maybe even working with some of these structures. But João Buzin from Tosini Ferreira is going to give us an update at a basic level, but also would dig deep into some of the more technical aspects of the changes and what we can expect from these investment groups coming up. So João, over to you. I know you have some slides you want to work with us as well, correct?
Yes, exactly, Robert. If you can be very kind and just allow me to project.
Okay,
let me
away
just
you go.
pull it up. Just bear with me a second. Just hang on. Share screen. There you go.
Excellent.
So it was a little bit of a spoiler down there. So for those who don't know me yet, João Buzin, one of the corporate partners with Tosini Freire. I'm responsible for our practice advising players in the alternatives space. Today, I'm going to be speaking about some of the typical structures for investing in Brazil. I don't intend to be as exhaustive, especially because of the limitation on timing. So the idea here is just to lay down some of the typical structures and talk about the pros and cons and what makes sense in each of the stages and depending on the strategy that managers are putting forward for investing in Brazil. So the first structure is it's fairly straightforward and very, very typical for early stage investments in companies that are either starting to test a tool or an idea without any sort of recurrency on testing the business model. So this is the typical convertible loan debenture structure that it's largely used by angel investors, seed investors, and other investors in smaller caps across the spectrum. Essentially, this is structured either as a typical loan, a direct loan from an investor. It could be an investor onshore or offshore. There's no restriction, provided that if you're an offshore investor, there's a registration of your investment in Brazil, then through the channel of a HOF with the Brazilian central bank, if it's a debt instrument into an invested company in Brazil. And there's also the possibility of structuring it as a debenture if the invested company is structured as a corporation, a Brazilian corporation, because this is the only type that can issue this type of security that is a debenture. The main advantage of this structure is avoiding associated risks, the underlying liability risks that comes with the invested companies. As you know, we have in Brazil some very intricate possibilities or some very intricate structures, legal structures for corporations that segregate the liability from the corporation from its shareholders. But there are some exceptions to that segregation of liability. So there's in labor relations, for instance, where shareholders can be held liable from obligations as a consequence of obligations of the invested company because of the notion of economic group. Consumer law also provides for the possibility of disregarding the corporate status of an invested company if there's any sort of abusive form. Environmental law, and there's also the possibility of having the corporate veil pierced if there's simply evidence of abuse of form for any reason whatsoever pursuant to Article 50 of the Brazilian Civil Code. So this is very useful for those investors who are willing to test the recurrence of the business without getting too much into the day-to-day of the company and exposure to risk. From the perspective of the invested company, it may well make sense because it gives the entrepreneurs some more flexibility to conduct their business, because in the end, if their only obligation towards the investor is to repay debt in the first instance. So they would have no, let's say, active influence from the investor on the day-to-day. So the investor would act only upon the exercise of its rights on the negative covenants to protect its investment in the company. So this is by far the most used alternative when it comes to investment in small caps. Then there's the direct investment, which is somehow a variation of the previous structure. When there's an equity kicker or an event that makes the investor get into the cap table of the invested company, it's obviously more invasive for the investor for the entrepreneur as a con, and it gives increased exposure to liability to the investor on the flip side. At least it represents a stronger commitment from parties to the investment, offers some synergies, and it's a fairly simple and straightforward structure. Obviously, there's the tax side of it, because it's not the most efficient type of structure when it comes to investment in Brazil. There are other more I would say friendly and favorable in terms of tax, which I'll give a little bit of overview in the coming slides. Then there's the FIP structure, which is by and large the most typical structure for managers that are looking professionally to raise capital to invest in the VC or the private equity space. And in this slide, still coming in from a perspective of a Brazilian GP raising capital in Brazil, for instance. Obviously, there's nothing written in stone. You can raise capital from either local LPs as well as international LPs. Obviously, it makes it a bit more difficult to balance the governance and any asymmetry in terms of the returns, because you would have on one side investors with dollar amounts being committed to the fund, obviously converted to Brazilian reais, but with an expectation to get a return in dollars, and having other investors in the FIP making commitments in Brazilian reais. So it's a very sophisticated regulatory framework afforded by FIPS. So it offers very clear corporate governance. There's a clear investment thesis because it's all gathered into a fund regulated type pursuant to Brazilian law. It's investor friendly because of the transparency and how tested it is. It's been in Brazil, especially after the changes we had in 2016. The FIPS have become even more popular than they were before. There were some rules that unlocked investment in other jurisdictions, for instance, because in the past, FIPS could only invest in companies in Brazil because of the favorable tax regime followed by a FIP structure, because there is a tax break on capital gains and the deferral of taxes once FIP exercise and exit from an investment. So there is no immediate taxation on income. So there's a deferral if it's a Brazilian investor or Brazilian investors or international investors with more than 40%, there is a deferral of taxes until the end of the life of the fund, when these events will be taxed, and the difference between the amount of investment made and the returns accrued by the investors. So I think that is there a question here? Just hang on. Sorry about that. I thought there was a question coming in from the audience. And feel free to make any questions throughout. I'll be happy to answer those. And here it's, it makes sense. This is the kind of structure that makes sense for those who are professional investors or GPs, typical GPs, and have a thesis and a commitment of more than 50 million reais for investment in Brazil. It's interesting because, and this is something that is about to be changed in Brazil. There is a public hearing of a change in one of the regulations that affect the FIPs about the role of the GPs and the so-called administradores, because there is this duality in Brazil in management of these entities, because not only the portfolio manager takes on the responsibility, but they also have to turn to an administrator, an administrador that does the sort of substantive work for the FIP. So it's a very passive position as opposed to the position of a GP towards the management of the portfolio itself. So there is a discussion now in the context of Instruction 555, which also affects the instruction applicable to FIPS, which is the 578, about the role of the GPs and the manager and associated liabilities in managing the portfolio. So now moving on to, this is the typical cross-border fund structure for investment in Brazil. And again, it has all the benefits of the previous, that I laid down in the previous structure. But it's worth just spending a little bit of time in explaining why there's this complexity when you look at the chain above the Brazilian onshore position. When you look at that, you see that there are three separate streams of flow of funds. This is because there's a rule under the FIP regulations that international investors can enjoy very favorable tax breaks, meaning zero tax on its returns, provided that none of them has more than 40% of the quotas or the shares that are issued by the FIP. So even when there's payment of returns, it's not a deferral of taxes, because there is another regulation for international investors and portfolio investors named 4373 that affords this tax break, that you can enjoy a benefit of zero rate at your returns going forward. Obviously, this may well vary because the tax rate on the 4373 is flexible, so it's a taxation on the returns, and also the what's so called the finance tax, the IOF. So the government can tweak the rate, but at historical levels it's been at zero rate for a long time already, and this is why you have this complex, very complex structure, and also. Cayman and other jurisdictions that charge less than 20% income taxes are considered for Brazilian purposes as tax haven jurisdictions. So that's why most of these investments are shielded with Delaware structures or structures in Canada, for instance, that are not considered pursuant to Brazilian law as tax haven. So that's
so João, we in fact had a question from the audience specifically about that, just flashing up. Cayman, then Delaware, then through into Brazil. Are you seeing other alternatives? Are you seeing versions where there will be coming, where we're seeing, I know through, for example, Luxembourg, but you see also in the same round, you're getting discussions about coming directly from Canada because people want to intermediate and get rid of the tax haven image, shall we say. Are you seeing a move towards newer structures over the past few years because of the pressure on the idea of the offshore fiscal haven and the tax haven being a place where people are not as comfortable? And also from your perspective, from the GP side, this is a construction and the cost, but also the LP side in terms of what they're comfortable with structures. How do you see that balance of power between the two, between GPs and LPs? And obviously we want to take care of the LPs so that they invest in the fund, but the GP also wants to keep it cheaper.
Mm-hmm. It's a very good question, Robert, because this is somehow related to the discussion we had about the UBO. That was an attempt by the Federal Revenue Service to disregard the whole structure because of the there were talks about abuse of form or people from Brazil, Brazilian domiciled investments going up in the chain just to benefit from the favorable tax regime afforded by the FIPS. So many people have been switching to Canada. For instance, it's a very good point, Robert, because Canada has essentially the same terms and conditions with which LPs are familiar with, and it makes a lot of difference because these guys they tend to be value predictability. So that's why it's very important that they're familiar with the terms and conditions and what they can and cannot do in terms of most favored nation and other terms and conditions for investment in alternatives in the alternative space. So Canada has been a very popular jurisdiction and for people to get rid of the traditional Cayman Delaware structure. Yeah, exactly.
The stigma of the offshore part. Do you find that also because of the demand of LPs in Asia or in Europe might be different structures that they prefer to see rather than somewhere from the United States, which is the bulk of the LPs, yes. So Canada is okay for the US, they're happy and comfortable with that. But what about the Europeans and Asians? Do you find sometimes that the larger groups will in fact maybe even have two structures set up or have multiples, or is it no, one size fits all and you should really just set up one format?
No, it's totally flexible, Robert, especially because it's driven by treaties and taxation, because it has to be, and some of these LPs, they simply don't pay taxes in their jurisdiction. So they're, let's say, institutional investors, the likes of CPPIBs of the world, as mentioned in the previous presentation made by Prequin. Some of them, they simply don't pay taxes in their jurisdictions, and they have to benefit from treaties and double taxation treaties and so on. So it depends a lot. There is no one size fits all solution. So it depends on.
It was more a question of the fact that the LPs, for example, in Europe, let's just say a PGGM or a pension plan in Europe, when they see that our mid-market manager in Brazil has decided to set up a Cayman Delaware structure or has set up a Canadian domicile, say, look, if you don't set it up in Europe, I'm not going to, or if it's in the Mauritius or in the Jersey Islands or whatever I'm comfortable with in Europe, I'm not going to invest in you. Do you find that that's a factor, or generally speaking, LPs will be flexible and will move geographies for structures?
They tend to be flexible, but it's a very good point you're raising, Robert, because if it's the majority of your fundraising comes from Europe, for instance, it doesn't make any sense to put this structure from US in place.
That's my point. Well said. Yeah.
So you would
plan where your LPs are, and then fit the structure that is going to be more likely from that.
Yeah.
Joe, we're gonna run out of time fairly soon. Final kind of like question. You did mention in terms of the smaller caps, we have a lot of part of our audience are going to be small, middle market growth and or VC early and later stage, looking at smaller fundraising mandates, and sometimes even down to a deal by deal basis. But you're saying that from your perspective, for the smaller cap captation demands, you're seeing a lot more use of convertible structures as opposed to necessarily fund structures on the offshore?
Mm-hmm. Yes, and there's a strategy that is finally picking up in Brazil, that is the venture debt fund. So you can obviously combine strategies if you're provided that you are having commitments larger than 50 million reais or larger than an amount that justifies the costs of putting in place a very complex fund structure. But by far, Robert, this is a very, I would say, simple and straightforward and useful structure for the smaller caps to test the currents of a business.
Great. Well, that's all we have time for. Thank you so much, Jean. Jean is available also on the InEvent platform for questions and answers, sign up to have a free consultation with him. It's very rare that we can get these lawyers on the ground for free and get all this great knowledge. So by all the means, use it. Thank you again, Jerome, for your time.
Thank you, Robert. Really,
segue into Kyle Dunn from MJ Hudson is going to be talking a lot about product branding, branding your GP, structures of marketing, email marketing, and all kinds of bells and whistles and tactics that you can use to try and get over this difficulty of trying to establish links with international investors. So Kyle, over to you.
Excellent. Thank you, Robert. I will share my screen.
And again, questions and answers or questions through the platform, please feel free. There's going to be a lot of interesting information on this particular round. I know there'll be some interesting questions out there.
Excellent. Robert, can you see my screen okay?
Okay, we're back to you.
I'm just confirming, Robert, can you see my screen? Is it?
I can see you fine, Kyle. It's just waiting for you to hook
I'm
up.
just sharing my screen. Are you?
It's good to go. Yes.
We're good to go. Excellent. Well, today, I appreciate the time. Today, I'm going to sort of talk to how to think about the marketing process and to readjust how you market and why, like, we are recommending that that process. A little bit of background: we're a true kind of marketing agency, branding agency for the asset management industry. It's kind of all we do. So we certainly have a good perspective. Jumping into this, how to think about marketing in today's terms. We have to understand how we got to where we got. In the old days, in the glory days, this used to be a sexy business, a sexy industry. A GP could go out and talk to a select number of LPs, and it was a refreshing offering. On the other side of the fence, the LPs had sort of select relationships with GPs. They didn't communicate to a broad audience or have exposure to a lot of different GPs. So they could easily make sort of decisions based on relationships and who they knew. At this point, it was a very inefficient market. The LPs had to, or were able to again make decisions off of just the select relationships they had, because it was kind of a burgeoning, growing industry. Then the internet happened, and the internet is really what changed how to market and how to think about marketing for this space. Today, LPs are forced to do a great amount of diligence when looking at GPs. They can no longer simply invest with relationships, because they can press a button and they can see this vast array of different GP offerings. So they have to account for that to be good fiduciaries in terms of the capital they're looking out for. So they in essence, they have to expand their outlook. They have to kind of look at a broader audience. And this is kind of reflective of how they communicated in the past. They could sort of communicate directly to the GP space. However, that's changed dramatically. This is how we have to think about marketing today. The LP can't just invest with their friends. They have to go online and sort of do digital research, go through their own discovery process. They aren't talking to GPs right away. They need to go and sort of resource and determine who they want to talk to. They then shortlist those prospects. And it's only at that point they'll look to directly connect with the GP. So there's three sort of core questions GPs face when marketing. It's again, what do the LPs encounter when they're conducting their discovery process, when they're going out there to learn? More importantly, then, how are you competing within that process? And the third point is a very significant point, because this industry is so performance orientated. However, if performance alone doesn't differentiate, and it typically doesn't, because you show me a private equity fund at 15%, 25%, whatever that return profile is, I can show you probably 50, 60 similar return scenarios. So when the LP is going to conduct that digital research, conduct that discovery, you have to be impressive, it has to be impactful, and you have to be different. And this is a little counter to this whole kind of institutional influence that people find in terms of when people think of being institutional, they tend to try to do the same thing as the larger funds. Well, that's the exact opposite thing that you should do. In order to be different, you have to really create that tension and kind of move away from the larger, how the larger funds position themselves. So if you aren't talking directly to the LPs, how do you compete? In essence, you have to build the digital technology underneath the communication process to monitor discovery. So you have to be able to track what the LPs are doing and then get to them before your competition gets to them. And this really pertains to this slide here. It's how do you move from performance-based positioning to brand-based positioning? Because the brand-based positioning is really what you're going to do when you're communicating to an LP audience. You have to think beyond performance. And why is solely based on this slide. And to pose the question, is it smart to build position around something you can't guarantee? And we have yet to meet an asset manager that can guarantee performance. So if you're solely building communication around performance, you live by the sword, you die by the sword. So if performance, it's essential, but it's not as sufficient. And how I like to think about this is pertaining to a BMW or a big brand like that. A BMW's car has to run well, but it's not the only thing that sustains the brand. But it's just a given at this point that those vehicles are going to perform well, run well. So this is inherently how you need to think about marketing in this industry today. The GP has to go and it has to build brand value around a given audience. And this is, in essence, your marketing strategy, your content strategy. So when you're communicating to LPs, you have to think, what are we going to say? What are we going to talk about? What are our core attributes beyond our performance? Acknowledging that your performance just has to be good enough. So you're going to communicate, and you're going to push communication out to the LP community. This is in the form of emails. This is in the form of events. This is in the form of press releases. All of the different ways, social, that you can communicate to LPs. You push in that information, but now you have to have the technology in place to build lead score and to monitor which LPs are engaging in your content. So this lead score is all through different technologies. What are those technologies? You have Pardot. Salesforce is obviously a classic one. You have HubSpot, you have Marketo, you have Acton. You need to implement the marketing technology that allows you to profile that LP interest. And once you see that engagement, it's then that you want to engage with the LPs and start the traditional kind of marketing or a diligence process, I should say. And that's what will lead to LP allocation. So where does that leave us? There's basically kind of 3 points to make when you're thinking about marketing. You need to transition from performance-based positioning to brand-based positioning. And that's critical to figure out exactly what that means. So what are your core attributes that is truly interesting to an LP? And you have to think about these pillars, and you have to create an anchor point around these pillars and be consistent in how you're communicating to the LP audience over and over and over. Recognize that the LP audience is going to go through discovery. They're not going to talk to you. They're going to go online and listen and learn. Because of that, your marketing platform, it has to be differentiated. It has to be interesting. It has to be progressive, relevant. Yet you then have to have the marketing technology underneath the communication process in order to adequately monitor what the LPs are doing, build lead score so you can apply a point value to different levels of engagement. And so the higher the point value the LP has in terms of what they're clicking on, what they're viewing, how much time they're spending on your materials, the greater ability you have to better prioritize who you talk to tomorrow. So marketing, it's kind of changed from, I want to go out and I'm going to talk to these 100 people, to I'm going to go and build audience and interest across thousands of prospective LPs. I'm going to let the technology tell me who to talk to, and then I'm going to prioritize engaging to those people who have engaged more than others. So that's kind of sort of fundamentally how to think about the marketing process today. So,
Kyle, would you say that when you talk about the that part of focusing on a smaller subset and trying to prioritize, that is very much tailor-made to the fact that we're looking at typical private equity funds or even venture capital funds where you do not have necessarily a large amount of target audience, where you're talking about your LP universe that you're looking to connect with starts from maybe 10 to 12 LPs in the first fund, and then you might move on to 20 or 22 in the second. And so that plays into that game as well. The fact that our target audience is not 100 million consumers of Nestle products. We're talking about the buyer at the end of the curve, right?
Yeah, well, and everyone always says, well, those tactics aren't those tactics retail-based, consumer-based, but it's actually more important for this industry than the retail industry. Like, does Nike really worry about that one person that's on their website? Probably not. If Texas Teachers is on your website, you certainly want to know that.
Right.
But
right.
yes, your first fund will have kind of, I don't know, 10, 12, 15 LPs. Yet, in order to connect with those LPs, you have to be talking to hundreds, if not thousands of prospective LPs, not talking to, but building awareness across those LPs to find those 10 LPs.
Correct. And you mentioned also in terms of content, when you're looking to reach out, I know there's a number of different stages when you're trying to differentiate yourself or trying to put yourself into a product position. In terms of like long form content, short form content, digital, printed, how does MJ Hudson view these different areas in terms of, what you should be? And I really appreciate the fact to say, look, you want to differentiate yourself. You do not want to be following what Patria is doing or what Advent is doing and the big players. You want to be focusing on what you're good at and what you have to offer. But in terms of general content production and ways of communicating with LPs as a whole, what do you find to be some of the best practices that almost all managers can follow?
Best practices, it's to think of how you layer your story. And to think about layering, just think about whether it is smart to put a paragraph on a freeway sign. Like, it is not smart to put a paragraph on a freeway sign.
That's a great one.
and this industry, when they communicate, they try to say too much too quickly. So you really have to figure out, okay, what are my core attributes? What am I trying to say in a very impactful way in the front end? And you have to take marketing risk, because you're not trying to prove the legitimacy of your fund and your offering. You're competing for time. So when you're competing for time on the front end, you're competing with people who are trying to get their kids to soccer games, that are have very busy schedules. You have to take marketing risk on the front end, do things that are a little bit different, really build a concise message, get someone engaged, get them listening, get them interested, and then that will sort of transition into more of a traditional diligence process. So one of the most successful things we did for a private equity fund is we put a world record holder of slacklining in a video. And it was a secondary storyline that we used to keep the viewer interested to hear the manager's story. And it's things like that that you need to do to compete with how kind of sort of star-struck the world is, and just of content. It is a YouTube kind of generation. So you have to do things that have that kind of sort of excitement and interest on the front end. And just talking about performance isn't sufficient, because these LPs, they hear your 15%, 15% over and over again.
And that goes into even to some aspects of all the different types of communication, because obviously a pitch book, a deck, the classic 20 to 25 page slide presentation that's full of detail, that people used to look at it as a form of a book that you'd have to cram as much as you can into a page, is very different to a type of communication you're looking to do before someone gets into that stage where they're looking at the fund. Kyle, tell us a little bit. We have very little time, and I know there will be plenty of questions coming through the InEvent platform. Again, I recommend people who are watching this get in touch with Carl. He's got a ton of different layers of information about different segments. One in particular, for example, just email marketing, where you're at the beginning of the curve, the beginning of the whole process. You're a small VC and you're looking to try and establish contacts. How much is too much? What's the best way to start the ball rolling? I mean, you just take a list of, Prekin was on beforehand, there's 17,000 LPs globally. I'm going to send them all an email tomorrow. Well, don't do that. How, just some tips and jikas for us.
First of all, the biggest tip that I have is to implement marketing technology right away. Get a good CRM system, get a good email system. Like that is the smartest thing that you can ever do. And second of all, it is never too late to start capturing communication and email addresses for those that you connect with. Prekin is one of the best resources out there. Go into that, understand who within Prekin may be a prospective investor, connect with those people, talk to those people, but ensure that once you do that, you're capturing the email in your CRM system and continuing to communicate to that individual over time. The more people that you can put into your system and you can communicate consistently to, the greater likelihood you will raise money over time. Mm-hmm. We all know this is a relationship-based sales model. So build relationships with people, but you can't do that on a manual basis. You have to use technology and communicate consistently. In this business, traditionally through email, it's pretty much the only channel that people use. A little bit of social, and that social is LinkedIn and Twitter, but.
Is it increasing, Kyle? Is that changing because of COVID and the pandemic? The last 2 years obviously have brought a lot of changes to the way we do business. Clearly LPs are not getting on planes as much as they did before, and we can expect that going forward. But let's just say we get back to events and people traveling, coming up soon. What's changed forever in this aspect?
Just marketing. Your marketing platform is becoming more and more important. Like what people experience when they go online is what is going to determine whether you get to talk to that person or not. And that's why a good website's important. Video is becoming incredibly important, A, because it's a medium that people want to use, but B, it can capture the charisma, passion, conviction of a human being. That's
Kyle, what's a good website? Because there are so many. I see so many static websites where people, they put it up because a junior is just say we have to have something online, stick it up there with a few static. Is it better to have no website than to have a poor one?
Neither of those are a good option, right? You have to have a website. A poor website is damaging. No website is more damaging.
Okay,
like
that's the first step.
If you don't have a website, you don't exist. Personally, if I'm looking and doing anything, I go online to research. If I don't encounter a website, that company does not exist in my mind.
Right.
Websites have to be more informative, say more than less. It's no longer cool to be this mysterious, like private thing. Like everyone just wants to go online. They want to get all the information they can and make a decision whether they want to engage or not engage.
Right. So that button that you typically see on some websites for like investors only, or they have to have access or whatever, and to kind of have to push into that format. No, we should be putting information in the public domain as quickly as possible. Not necessarily returns, but this stuff.
As professionally as possible, make it engaging, make it interesting, use fewer words, design is important, be professional, all those things.
Perfect. Well, anyway, we've gone well over time, but it's fascinating. There's always plenty of information with Kyle. I spent 2 hours with him on this call before we had this 15-minute introduction, and I actually really enjoy speaking with him and hearing about the inside play as to how the industry is evolving in this sense. He will be available again on the event platform for meetings. Respect the fact that he's 4 hours behind his back on West Coast USA time, so please respect that. But I know he'll be very eager to connect with managers out there who are looking for ideas in terms of how to turbocharge their efforts on both the GP positioning, also on marketing, and there's all kinds of things that MJ Hudson are putting together here. So really appreciate your time, Kyle, and MJ Hudson's support of this event. We're going to be going into a break now, a very brief one, so we can all get up, go to the bathroom, and do the coffee round and everything else. I'm dying for a coffee, so we'll switch over into a pause mode, and we'll be back exactly at 11:15. Don't be late, because we've got a lot of information to be covering in the second half. Welcome back, everyone. So here we are. We're going to be kicking off for our second half of this GP Bootcamp. Edgar, once you flip out, and we'll be coming into setting up with our what we consider our LP panel. This is who we have to convince. This is who we have to find a way to talk to discuss, to engage, to basically to become friends with and go forward into the next stages, tell the story, move forward, all the strategies, all the tactics. It doesn't mean anything unless we're able to get the word and the feedback and the money eventually from gentlemen such as Cesar Carlier from Sigler Guff and also Joaquin Bourdon from Julius Baer Family Office. Thank you both for coming along in today. We're going to be talking not specifically cases. We're going to be talking very much in an open format, and questions and answers from the audience are they're not necessarily helpful, but they are required. So people who are online here, please send specific questions out to us. We'll try and format them and fill them in as quickly as possible. We have a very short period of time for two very influential and also with plenty of track record in history in terms of going back and investing in the region. And I'll ask for each of you both just to put a little bit of perspective on that, so everyone has your curriculum. But why don't we kick off with you? Just make it real quick. Cesar, talk just a little bit how many years you've been down here pouring through. I know you've got over like 140 GP contacts that you track over the past 10 years or so here in Brazil and in Latin America. Tell us a little bit about that, and then we'll flip over to Joaquin, and then we'll start into more specific questions.
Sure, Robert. Good morning. Thank you very much for being here. Thank you to ABVCAP. It is always a pleasure to try to contribute to the industry. Well, Sigler Guff is a done in the past a lot of fund-of-fund activities. We consider ourselves a mixed strategy private equity fund, which we use the fund-of-fund activities to get sourcing of direct investments. And as a consequence, we've established 400 fund commitments in the past 25 years. We are here in Brazil since 2007, and we've established more than 30 investments into private equity, tech, and distress funds in the region. We also have a direct investment activity both in companies, which we've done 10 companies so far in the co-investment side, and we've also have a direct activity in what we call the legal claim space, which we believe we are the leaders in the country with $1.5 billion of AUM. Here globally, we have $14 billion of AUM. Here in Brazil, $2.5 billion of AUM.
Perfect. That's a perfect summary. Thank you, Cesar. It gives a good idea of like the extent, the time, and also the volume of capital that's been applied. Joaquin, tell us a little bit about where you are now at Julius Baer, but also your past with DEG.
Yeah, no, pleasure to be here, Robert, Cesar, as well. Good to speak with you and the qualified audience. So, Julius Baer Family Office in Brazil is the result of the combination of GPS and Reliance. Today, we have more or less 70 billion reais under management, being one of the most relevant family offices in the region. Julius Baer Family Office is a fully owned subsidiary of Julius Baer, the banks in Switzerland. And in Brazil, we started our private assets program back in 2015-16. Since then, we got some relevant exposure to VC, PE, and infra. I'm responsible for these three areas, both locally and internationally. And in general, I have a preference for these that are less correlated to GDP, given the volatility of the Brazilian economy. Just to give an example, we have also a fund of funds focused on VC, and we gave allocations to our clients to the key early stage funds in the region, did some PE and infra investments as well. And we are flexible from primaries to co-investments to secondaries. That's our strategy in the region. Internationally, our strategy is more concentrated on investing in funds, the names that we like most, and we are building our exposure there.
Perfect. Well,
just quickly on DG, before joining Julius Baer Family Office, I worked for 7 years at DG, which is the German investment corporation. I was one of the persons responsible for investments in South America, mainly Brazil, and did some investments when I was there. Yeah,
certainly some. You did quite a few, and I know DEG continues to be extremely influential in the region. So there's three very interesting points of view here between the expansion of Sigler, the activity of Julius Baer on the family office side, but also in a DFI in the background, and that kind of feedback that we can give. So we have money on the table, and we have people willing to take questions. And so taking advantage of this, I'm expecting that our 50 participants are going to be showering you with documents and with PPMs and saying that what they want to do. But until that comes up, Cesar, roll us through a little bit about, obviously you've got this massive universe of potentiality. You have capital in hand, and so people will come knocking on your door, and they're going to come after you, and they will be looking to establish contact, knowing that you have dry powder and capital to invest in their funds. Going beyond groups that clearly don't come down one of your channels of influence. Let's say you're not looking to go after a very specialized particular sector fund because you know it's not going to be doing that. But what are the core attributes that you look at? In fact, we brought this up in the previous session. Core attributes beyond performance, okay? The strict performance, it seems the performance data and the returns on funds are becoming less and less important. Yes, everyone says, well, I want to have 2.5 to 3x returns on my fund. Okay, great. But realistically, when you see a new manager comes in and establishing a relationship with you, what are the core attributes that you look for, but also that you will look for a way of interacting with that particular manager to extract that information when you're trying to get a feel for one of the 40 groups that are, for example, on this call right now that are thinking of reaching out to you? What are the best ways that they can get in touch with you, and what are the things that you really look for?
Yeah, sure. I'm just gonna broaden a little bit the scope. I mean, you have to consider in the world we have 5,000 private equity funds raising money. I'm inside the Global Investment Committee, which is actually going on right now as we speak, and I dispute capital within my firm with China, US, and everybody else. So the same situation passes through any international LP. And so you're going to face a very strong competition. And so what you're looking for is really differentiation. You know, what are you doing differently? What sector of the market? How are you approaching that sector? How are you sourcing? What does your team look like? Why does the pipeline become maybe not proprietary, because that's one of the most common things that are said out there, but
says that, right?
yeah, exactly. But maybe not proprietary. But why do you have an advantage against the others when you're talking about pipeline? I'll give you some examples. Okay, so we like scars, for example. And in Brazil we tend, and I'm Brazilian, we tend to hide our bad factors and only talk about the good things. And this is
track record too, right?
When we're talking about economy, we only speak about the good things. When we're talking about COVID, we only speak about good things. Even our forests, we only speak about, you know. So all the way from the macro to the micro, we don't talk much about our lessons learned, and what that does is it brings skepticism from the LPs. They will look at you saying, "Oh, you're just pitching," and it's great to see when someone says, "Look, this is what's happening good. This is what's happening bad. This is what happened with me, and that worked, and this is what did not work," which creates it transmits maturity. So we joke internally that we like people with scars, right? So we like people who have had that experience. Another example, which is very common recently, which is a trend, and actually you see Brazil in this crisis and all the bad mouthing that there is internationally about Brazil. So when we look into a manager here, we say, okay, well, what are you doing different from a deal basis? And a number of managers who have raised capital, and very few have raised recently, they have done different structures. It's not only about valuation. It's about valuation and downside protection and deployment of capital in a sense in time. And once you show that, you say, oh, okay, so then I have not only a lower valuation than public markets and maybe other countries, but I also have a risked approach where you have sometimes minimum returns. Our last 3 deals directly were done with minimum returns.
Structure of the deal. You're talking about structure of the deal, not just the,
yeah. So structure for us has been something extremely important, because you can increase your protection. But of course, I mean, I listed 22 items here, but I don't want to go after. I'm just trying to think about what's really important. I would say the last thing is, increasingly the world is looking for co-investments. A track record of co-investments is something very important. The ability for you to be a partner to some LPs is something very important. Of course, I advise to choose the right LPs, because sometimes you can have the wrong LPs as an investor and they're a liability, not a help. So we try to think of investors that can help you have a better performance. That's the way we like to see it. So,
but you recommend, just to go on that theme and just a little bit further, this is a very common format to try and get engaged with an LP before they come in as a primary investor in your fund, is to get them interested in a deal that you're doing, because you can show them the way that you work, the way that you put stuff forward. It's clearly a positive marketing tool, but you feel also that it's important that the GPs are choosing the right people from the word go, perhaps groups that are not going to get their hands involved in the deal as well.
There's a common error, which is, Robert, trying to link the co-investment rights to the size of the check. And I think that's an error. It makes sense from an economical point of view. It looks like something logical, but I don't think that's the right thing. Private equity is not about just the check. It's all about operational improvement of the companies that you're in. That's the core belief that we have. Right. I myself, I'm a former operational guy. I've been 12 years in retail before I joined private equity 15 years ago. So we strongly believe in operational improvement. So if you have that in mind and you believe in that, you have to bring to your investment people that can help you in the operations, some way, shape or form, is either internationalization or management improvement or whatever it can be, but you have to bring into LPs that can help you there. So I think really it's important to do that. Of the 10 co-investments we've done, 3 were in that category, Robert, that you mentioned, which is we've seen the deal first and then invested in the manager, and it was wonderful. We really liked the experience and did that, but we were brought into that deal because we could help on those deals. So I think at the end of the day, very, very important to have that equilibrium.
Yeah, I think we'll see that also from some of the smaller, even some of the VC funds. We're going to get that more interaction with LPs. So choose your LPs wisely. Joaquin, from your previous time with DEG and also now with Julius Baer, it's clearly been a change and a evolution in the way that COVID has forced us all to change the dynamic of interaction between LPs and GPs, starting off initially with a complete lockdown and now starting to actually move forward into a post-COVID scenario where we're starting to see that we're getting perhaps a little bit less on the travel side, and LP relationships are going to be dealt more at arm's length until we get to the decision phase. How would you say that the COVID crisis in fact changed the LP-GP relationship formula? And if you see any of these changes being either temporary or permanent, and add into that as well, you as an LP, what you feel during this period of time over the past year and a half has been effective to get your interest in a fund manager?
Yeah, no, very good question, Robert. I think one first comment that I'll make to contextualize is that even though we have very high liquidity in the market, fundraising is very concentrated. So there is some large companies that concentrate great part of the fundraising, and that is explained by basically 2 factors in my perception. So first, LPs are basically scaling back the number of relationships that they have, because over diversifying, they're gonna get the average returns. And second, some of the GPs became really franchised. So some GPs started as a kind of PE fund, then go to a senior equity, senior debt fund. So that led to the kind of concentration. And in terms of due diligence, what was more simple became very challenging to say. So the LPs are not doing DD in DGP just during the fundraising, but it's a very constant contact. The LPs are always challenging, having conversation with the GPs, so that changed. And also at fundraising, in the past was more kind of a relationship. If you kind of were fine with the guy, after 10 meetings, we'll basically invest. But nowadays it's a very thorough DD that involves the operational part of the firm. ESG became more relevant. So I think that trend is important to consider. And with COVID, I think there was no huge impact on the relationships that were already established, because it's very constant, the contact between LPs and GPs. What is more challenging is to start a new relationship. That's more challenging. Not being on the ground makes things more complex. And I think to call the attention, the second question that you made, I think being on Zooms the whole day is a bit, you basically get tired. So yeah. I think just going through your deck, your pitch doesn't help much in my perception. And it's important to have to have your message transmitted, and in my perception, at least, telling your story, where you're coming from, what is your plan, when you want, what's going to achieve in 5 years is more important than just going to deck. So I think that calls usually more the attention, learning the story of the manager than just going through a pitch book. Because if the story is interesting, next step, we're going to go to the background materials.
And Joachim, you'd say this more in terms of like let's say the initial reaching out process of chasing LP, getting to a contact with them. This would be from the moment that you've got the first meeting, which would normally have been presential, but instead it's going to be on Zoom. You recommend it's not just a question of materials and stuff on the side. You'd like to see that they're going to be a little bit more personal and talk a little bit about their story and them as individuals, focusing on the fact that the people are what make the business work.
Yeah, I think that is the most interesting part in my perception. That's what we'll call the attention, to at least put the guy, the manager, in the kind of potentials list for you to deep dive down the road and consider investment. But I think just going through the pitch deck, I think it's what everybody does. Doesn't call much attention unless you have a kind of stellar track record, and the numbers will basically be very interesting. So I think telling the story calls more the attention usually than just going through a pitch deck presentation.
Yeah. I agree. I cannot agree more with Joaquin. I think objectivity is something that we lack as a culture. We need to be objective, straight to the point. Elevator pitches, you have to, what's different about you? What's your background? I mean, that is something so important. The minute I realized that within my firm, I got much more deals approved than trying to hit all the buttons to explain something. You have to hit the good, the bad, very objectively, very quick, and smart people will realize that you are something interesting for them to do or not.
Right. Okay. Well, when you talk about showing the scars and showing the negative side, it always reminds you of the Clint Eastwood scenes when someone's saying, "Well, I want the gunfighter who's got full of bullets and got lots of scars on him." I said, no, you want the gunfighter like Clint Eastwood who has not one scar on him. But in this case, when people want to see that's the lessons learned from those scars that make all the difference. Cesar, from your point of view, and Joaquin, let's get your weighing in on this as well. In terms of best practices that you've seen over the past, maybe it can be even in the last couple of years, but going forward, to continue the dialogue and to get your interest over time. Clearly, there's the initial contact, there's the material and so on. Give a little bit of focus on some best practices that you feel that you've received that have made you more interested in one manager or another beyond the qualitative aspects of their strategy and what they're doing. When you see, I said, no, I really need to see strong compliance, and I know that they've got the background checks done, and I know that they're doing this. Or no, I really need to see much more interaction on the investor relations side with me. I want to know that they're after me. Or no, I like to see the operational deal flow. What are some of the best practices that you've seen, just very quickly, that over the past 2 years that you say, like, these are managers that I've been following that I'm more excited because they do this?
Yeah, well, I'll tell you a very tactical one, which is you have to have somebody knocking, on everybody's door. I mean,
but in what way? What knocking with what? Like free tickets
reminders,
to the
you have to set up calls, reminders, WhatsApp. You have to be there. You have to be live. You have to engage somehow with many times you're going to say, look, not now, talk later, but then you have to come back again. I mean, if you
co-investment or something like that, be there with a deal that you're doing.
We have like 12 people in New York just doing that the entire day. They're just knocking on people's door and everything. The good managers, Vinci has Pedro and the team doing doing that all the time. I mean, we interact with them a lot of times, but they're there. Patria does the same. Advent is constant. Each one does it in a different way, maybe through reports, maybe through emails of what's going on.
So they have big teams, okay? Everyone on this call, we got like 50 people on this call, and none of them have a team of IR more than maybe the founders and 5. What can they do to cut to the chase?
You have to have one person dedicated to fundraising. It's very tough for you to do this on, because the founder, they have to be worried about. They have to be worried about the core business. So,
right. Which is making money.
Yeah, but I would say, besides that tactical point, I mean, we like consistency of fund size, consistency of valuations, structures, things that are done again and again and again. And lastly, because we believe in the operational side, we like to see also how do you improve operations? Do you have an operational team working with you? Do you have an operational network that's working with you?
Right.
It's very common, but we like to look a lot into that.
Yeah, Joaquin, from your point of view, best practices that you've seen have made you more interested or less interested than perhaps a potential GP relationship? What have you seen that really rings your bell?
I think as a principle, it's important to be very honest and transparent. There are just a few investors that are looking at the region and they speak to each other very often. So being very transparent, I think, is the beginning of everything. And being fast in conveying the bad news is important also. You don't know, it's preferable to hear directly from the manager than to see in the news. So I think that is a very basic principle that some managers sometimes don't give the proper value. So be transparent, tell the bad stories, as Cesar mentioned, is very important. And then I think it's important to see traction. If the guy just knocks on the door when he's raising a fund and he constantly doesn't deliver, that doesn't help much. So it's consistency. I think, being consistent shows some investment traction. Better not to have a fund, but start deploying capital through syndicated deals, doing co-investments, presenting what you're doing for the LP to be aware of what you're doing on the ground when a more kind of structured fundraising comes. So I would say that showing traction, investment activity, it's more important than just reaching out when you want to raise money. So actually it's something before you need to show your work, your consistency for the LP to be aware of you. Therefore, he will not start the work right after you called him.
Fantastic. Well, we're over time. I could go talking on to you two for a lot longer. There's a lot more information that we could pull out of this, and I do recommend to our audience, both Cesar and Joaquin have been kind enough to put themselves on this in-event platform, so they are open for business and open to take your calls and meeting requests on the platform, which I think was very generous on both their parts, because I know that their time schedules are very full. Thank you again, Cesar and Joaquin, for coming in and for giving us your words of wisdom on what it is that LPs are really looking for. Now we're going to downshift to another layer of importance for GP investing or GPs looking to fundraise in the global and international markets, going into placement agents. And we have Leonardo Camazotto from HMC Itajuba. A lot of you already know, a very famous figure in the local market. Welcome, Leonardo. And I believe you've got some slides for us to kick off as well, some of the pros and cons and do's and don'ts of placement agents today. Is that right?
Yes. Thank you for the invitation, Robert. It's a pleasure to be here, and count on us as much as you can. Yes, I have prepared. It's a short conversation, so I have prepared really 3 slides just for us to go through and I mean to organize the ideas and then open for questions and a kind of conversation, which I believe is more useful for the audience, right? How's the best way? Should I upload from my
just go ahead and share your screen with us.
Okay.
I should have the.
Let me do that.
Kick off. And then we'll go, again,
okay.
open for questions from the audience through the in-event platform. Feel free to send them through. There's a lot of good stuff here.
Okay, thank you. So thank you everyone for being here. I mean, it's always these events organized by Robert and ABVCAP is always very instructive to everyone. I mean, the idea here is to show advantages, challenges, and difficulties to work with placement agents in fundraising instead to work by their own. I mean, who is HMC Itajubá? Just one slide for us to put in perspective. We are one of the biggest placement agents in Latin America. I mean, we were established as a JV between Itajubá in Brazil and HMC in the Andean region back in 2011, so 10 years now. In this period of time, I mean, we have raised $30 billion plus for private equity, venture capital, timber funds, real estate funds, which is more what we call closed-ended. But we also have a platform to raise capital for open-ended funds, which has a very different dynamic. They split between the two is more or less 2/3 towards liquid investments and 1/3 in a more placement, closed-ended type funds. Just to put in perspective, I know that most of the audience knows us, but it's always good to put it in perspective. I mean, these 10 years, the company has grown a lot as the asset class did. So we are nowadays 80 people plus in the key markets in Latin America, Brazil, Chile, Peru, Colombia, and Mexico, and few partners in the US, and in the process to establish also a presence in Europe now. Okay. So regarding the placement agent, I mean, we can go very straight to the point. I mean, in a pros and cons dynamic. I mean, most of you know which is a placement agent. We are not magicians. We are not doing anything that cannot be done by the GP. So I would start with the main pros to use a third party in the fundraising is the experience and the knowledge, which I should have added the focus. I mean, fundraising and the relationship side of the asset management business is nowadays something that requests focus. I mean, Cesar finished his speech in the previous panel saying that he believes almost every GP must have someone dedicated to investor relation, which is true, because I mean, as much as you dedicate time, you're gonna accumulate experience and knowledge about the investors. The placement agent has an advantage to only do that. So this experience is huge. I would say that if you track it properly, over time, you're gonna know by heart, I mean, what the key LPs in the market are doing, their preference, their restrictions, how they would prefer to communicate, their timing to make decision, and everything. So this is critical and make the fundraising process much more efficient if you know that. So this is one of the key pros to use a placement agent. The second topic is more intuitive. I mean, is improvement on all the pitching materials and how to go to market, how to build the storytelling. It's a kind of anecdotal joke as a I don't know, a real estate broker. I mean, we in our lives maybe change house 5 times over our lifetime. A real estate broker probably do 5 deals per year or 10 deals per year. Here's the same. I mean, a GP may raise fund every 3 or 4 years. So in 20 years time, it will be 5 rounds or maybe 6. A placement agent does 6 to 10 fundraisings per year, reviewing materials. So it's much more experience in how to build this storytelling, which is very appreciated on the LP side. The third topic, which I believe is important too, is alignment of interest in terms of economics. And here is basically the trade-off between fixed cost against a success fee. So the placement agent is a structure that brings alignment in a way that the remuneration or the cost on the LGP side is variable, right? It's based on success instead to incur in this cost from D0 without much visibility about the fundraising, right? Fourth point, which is critical too, is the placement agent goes much far beyond the fundraising itself. So due to its relationship, when a GP engage with a placement, it already hired a service on brand awareness. So you can coordinate with the placement. I mean, a bunch of meetings and work to be done on a low probable investors, but investors and members of the industry or whatever that are important in terms of branding. So this is, I believe, is something that a placement could shortcut if the GP try to establish it by itself, right? And a few other topics on more the operational side. I mean, the placement agent could be very helpful in structured vehicles, understand the local regulations. So when we are discussing about global fundraising, each region, each country has its own specificality. So the placement agent can be very helpful in design the right strategy and structure to access the pools of capital. So this is the beautiful slide. Let's go to the more.
Let's get on to the cons. Here we go.
Yeah, the cons. So let's go to the challenge part. I mean, so the cons and some mitigants that I believe is critical for any GP that is considering to engage with a placement agent must pay attention. So the three main cons that the industry may blame to hire a placement agent is, first of all, I mean, every time that you choose a third party instead to do by your own, I mean, this third party has its own priorities, its interests, and they work for more than one, let's say, contractors or clients. So this is something that may bother some GPs because they want to control the timeline, they want to control the relationships, and so on and so forth. And a placement agent, by definition, will be working for more than one GP over time. And this could be blamed as some distraction and is something that must be coordinated and mitigated, but it's impossible to bring to zero. So this is one of the main cons that I believe is worth to mention, right? The second one, and we can stay hours talking about that, is about the cost. I spoke a little bit in the previous slide. I mean, the change or the trade-off between fixed and variable cost. Another point that's important to mention is that the intangible benefits to use a placement agent, but at the end of the day, GPs can blame that a placement agent is very expensive. So this is something that should be considered because, I mean, in a successful fundraising, of course, the bill will come and must be paid to the placement agent, right? And the third point that we heard a lot in the industry is when you use a placement agent, maybe the relationship stays with the placement agent and not with the GP, right? This is another critics that we hear a lot. But I mean, as I'm gonna go through in the mitigants, I really don't believe this is true, but it's something to be considered by GPs, right? Which are the mitigants for these cons? First of all, I mean, know your placement agent. The placement agent business, consider that it's is based on success fee, somehow the placement agent is buying options against the GPs. So you're gonna have placement agents that has the philosophy to buy many options and establish as much relationships as they can. They know that they will not deliver to all of their clients, but they will make money at the end of the day. So this is one extreme model of the placement agent, and the GPs must be very careful in understand and, in my opinion, avoid this type of model, because you can end up being the GP that is not the successful case. The other side of the coin are placement agents that really believe that they must deliver for all GPs. So I have shown you some numbers on HMC, and I mean, we can end up raising $1 billion in a given year, but if I don't raise capital for a single GP that has hired me, I will be very upset. So this is our mindset, is how we work. So we must raise capital as a firm, but we must deliver for all the GPs that hired us. So know your placement agent is critical. Regarding the overlap is connected, right? I mean, if you understand the mindset of the placement agent, you know their current offering, you can really organize and be coordinated to avoid overlap in terms of strategies and in terms of timeline. So if you are a VC fund, doesn't make sense that the placement agent is raising 3 venture capital funds in the same time, right? Or 2, whatever. So this must be coordinated. You can put in contract, in agreements, but it's also about reputation. So placement agents, they build reputations over time, and like the GP does, and this is important. Is one of the mitigators on the distraction cons that I mentioned above, right?
That's certainly a very important element in terms of building the relationship, how it's different. Now, theoretically speaking, although the GPs are in there paying the bill, quite often the relationship that you have, the long term that you're bringing that provides value for that payment is in fact your relationship to the LPs. So tell us a little bit about that balance of power between a GP and an LP and how a placement agent has to balance that to favor treating the LPs well and that relationship that you have with them.
Look, I mean, LPs in general, they have their problem. I mean, they need to deploy capital, right? And the market has a huge offering. So they will always pick up first the phone of people that they trust, they like, but also know what they want to invest, also know how they look for investments and so on and so forth. So the placement agent will shortcut that.
And you're not going to be showing them things that they're not, that you know that they're not going to look at. You won't waste their time. Exactly. You're only going to go after the group. So that might limit your LP universe for that fund, but that's not important. What's important is when you go to the LP that you know that they're going to take the meeting.
Exactly. So that's why we usually take the preference of answering from the LPs. But just after that, the relationship must start to bridge between the LP and the GP directly. This is the way that we believe as a placement agent. We are not an intermediate. I mean, at the end of the day, if the LP decide to invest, they will become a LP of the fund. They will be client of the GP. There is no structure in the middle. So that's why I put in one of the mitigators that if a GP decide to work with the placement agent, the GP must be prepared to leverage all the relationship that the placement agent bring to the roadmap, and then start to establish this direct relationship. So it's a kind of a sum up of efforts. I mean, the placement agent will give deepnesses to the commercial capabilities of the GP, but will not substitute that, right? So this is how I see it. It's a kind of teamwork.
Yeah. No, exactly. And it's again, the public we have for this particular boot camp are tending towards smaller and smaller capitalized bases of groups, which are going to be looking for smaller funds initially, somewhere between maybe 50 to 75 to $150 million at the beginning. And the economics of international placement agents is clearly tending towards a preference to larger funds. And in particular, seeing as the global private equity universe, as we've stated, is not working to help us in this, and that the larger amount of managers with larger funds already on the road. So to get the excitement factor and to get a placement agent really interested in your product, that really believes in you, is going to go the extra mile to get it to those LPs. What can a GP do besides reaching out and to talk? What type of time period are you seeing? You can find the most amazing placement agent, turn around and say, "I'm sorry, I'm too busy right now." How can GPs short circuit that longevity process and come straight to the gaps with a potential placement agent that's out there?
Right. It's a very good question. I mean, first of all, it's a weird market. I mean, because at the end of the day, the GP hired the placement agent, but before hire the placement agent, they must convince the placement agent that
to invest in them, yeah.
Exactly. So it's a kind of a strange dynamic on the client's point of view. But what I should mention to you, there are two key factors in my view. First of all, I mentioned a bit about the know your placement agent. So there are placement agents that are very transactional, which means the placement agent will do the very simple calculation. I mean, the amount of capital that they can raise times the placement fee times the time that it will take to raise that. So let's put on average
exactly who you're talking about.
12 months, $100 million fund, 2% fee. They will make this math and will say the expected value of this transaction is, I don't know, $2 million or $4 million. I take the deal. These placement agents that are very transactional, if you are below their bar of the minimum expected dollars per transaction, will be very tough for you to get in, right?
Right.
So for smaller and mid-size Latin American GPs that want to go for global fundraising, they must look for placement agents that are more mindful in terms of which GPs they want to represent. So this is the second point, the first point. The second point is, if you find the most mindful placement agents, how you show them that you are not there just for one fund, just for one transaction.
Okay.
So if you show, okay, look, I mean, my aim in Latin America is to become, I don't know, top 5 VC fund. My first fund is 100 million, but I will probably raise capital every 3 years. The plan is that. And I would engage with a placement agent with a preferred second and third round. But let's make a deal for the 3 funds in a row. I mean, show a kind of a project. This will call a lot the attention of the mindful placement agents, not the transactional ones.
Right, who might be otherwise picking and choosing a little bit more difficultly. Put a little bit more skin in the game, a little bit more on the table to allow them. I have heard that also in terms of carve-outs, when you're saying, I'm looking to raise 150 million, but we've already got 100 million that we're already thinking about. It's not leaving much there to make it worthwhile for the placement.
Yes. Maybe in this carve-out case, maybe sometimes is more intelligent to negotiate a lower fee in a limited universe where you already have a relationship instead to fully carve out.
Right.
For example.
And that brings a whole slew of additional questions in terms of how to work an existing relationship, why a placement agent can actually help you develop an existing account better than you would have done yourself anyway, as part of a whole flow, in terms of the strategy of the mandate, in terms of trying to push to show escassez, a little bit of shortage of capital to generate some interest in the actual mandate. So there's an awful lot to go through, Leonardo. We have to cut off now. We have to go on to the next panel. But again, just to remind all of our participants that Leonardo has kindly agreed to also be on the InEvent platform. He's there available for questions and for setting up meetings. So do take advantage of that. Awful lot of good information there and feedback that you can receive on your current GP process, what you're looking for, and your campaign strategy. Go and tap into Leonardo to get some good ideas on that. Again, thank you, Leonardo. We'll move on from here into our final session, which is we're going to be talking about two groups that have actually shown success in the international fundraising market and some of the difficulties and trials and tribulations that they've gone through. So Anderson Sees and also Gustavo Iben from Aqua, Anderson from Red Point eVentures. Thank you both for being online and with us. And again, questions, Q&A from the audience who are tending towards growth capital, VC funds, and across the board, more than welcome. Again, Anderson and Gustavo, thank you for being here with us. Perhaps to kick off, what we should do is just have just a quick recap on the journey that both of you have been through in terms of your GP and where they have been in the campaign and the fundraising process over the last few years. Anderson, why don't you kick off and just give us a little bit of a roundup of your journey on the fundraising side over the past few years?
Okie dokie. I'll do a quick through from the beginning of the firm, Robert, if that's okay, because it's I think it's relevant, but I promise I'm going to do it very brief.
Feel free. First
off, thank you so much for the invitation, and hope we can help out somehow today here. So quick recap, we are early stage fund investing mostly in Brazil. We have a Latin American mandate, but most of the deals are in Brazil. And we do primarily Series A, and we also do seed rounds and Series Bs. We raised our first funds in 2012. That was $130 million, 100% international capital, roughly 2/3 from US investors, 1/3 from European investors, and also 2/3 institutional investors, meaning fund of funds mostly, and 1/3 from corporations. And our second fund we raised in 2018, took a lot longer than the first one, and it's mostly Brazilian investors. There is a fair amount of family offices, multi-family offices, corporations as well. And the novelty in the second fund is we did a partnership with Itaú and XP for distribution to their client base. And this was $175 million. And it's the fund that we are investing from right now.
Which was more towards the domestic side.
More towards, sorry, I missed it, Robert?
More towards the domestic side.
Oh yeah, on the liability side, yes, it's up. Most of it, it's over 80% local investors. So we flipped the entire limited partner basis, and we can talk about it, but
yeah, which is certainly very interesting about the aspect of trying to go to where the capital is trying to reach out to you, which is an important lesson to be learned for everyone across multiple cycles. Gustavo, a little bit of your background personally from before Aqua as well as a placement agent, but talk a little bit about Aqua's journey as well and your current moment in the fundraising cycle.
Certainly, Robert. Well, first of all, thanks for having me here. It's a pleasure to be talking to all of you guys. So my personal experience is that I've been doing fundraising for way too long now, probably 20 years. You know, I started my career as a placement agent within the UBS placement agent group, and I would say half of my career, the first half was mostly raising US and European funds, always on the private equity side, but you know, on different asset classes as well. But I would say mostly on the private equity side. The second half of my fundraising career, I started to do, I would say, mostly emerging markets fund. And I think it's interesting that distinction, because raising money for Blackstone is very, very different than raising money for Aqua, for example. I've been a placement agent, as you said, 3 times in my life, also way too many, within UBS, then JP Morgan, and the third one was my own placement agent activity. And then in terms of Aqua, you know, we started fundraising back in 2012 when we raised our first fund. That was shy of 200 million. And then we went back to the market in 2016 when we raised our second fund, and that was a little bit short of 400 million. Our LP base is exclusive internationally. I would say it's a combination of US, European, and I would say rest of the world, with some sovereign wealth funds and family offices in the Middle East, and some Asian LPs. But I would say 100% institutional LPs within that framework. And for Fund 3 that we're planning to come back to the market soon, we're contemplating the idea of raising local money for first time.
Okay, well, that's some very interesting points of view from both sides of the equation. I think I'll revert back to you, Gustavo. You mentioned specifically about, and Anderson will put this in terms of, let's just focus on the international fundraising side. There's tremendous, and I know Baku will also look for local fundraising as well. And the balance of power between local and international is something that we'll have to deal with going forward, and all kinds of other variables, macroeconomic variables or tax or regulatory side could change that overnight. But let's just focus here on the international side, which most of you have gone through fundraising processes successfully. Gustavo, from your point of view, and also pulling a little bit on your own experience as a placement agent beforehand, when you're talking about the different core markets of the US institutional investor, European institutional investor, and also Asian institutional investors, do you have any kind of, not necessarily best practices, but through Aqua's relationship with these investors, both directly and also with placement agents, what are the lessons learned you'd say to us who are all looking to perhaps get started on this journey, to say, look, at the beginning, deal with, you know, small mids more than you would with the larger ticket, or not, or do the exact opposite? Lessons learned between the different geographies and the different types of investors that came into your fund structure.
Yeah, it's a very good point, Rob. I would say, to start with, that you know, if you're serious about raising money, the U.S. market is a market that you cannot ignore, right? I mean, the U.S. market is the largest LP market in the world. Obviously, depends how much you're trying to raise, where are you in terms of your journey, in terms of funds and size and team and track record, which is no minor. I think the moment we leave our own domestic market, we need to be very prepared to defend and basically have a track record that we can talk to LPs. You know, and I like to illustrate a lot of this by example cases of real fundraising. You know, it's very interesting when you're working on your deck and you spend hours and hours and hours and slides talking about everything that you want to communicate. You sit here in any meeting in the US, and first of all, I think you have 15-20 minutes, not much more than that. You take your deck and you can see the LP going straight to slide number 16, which is a track record. And that will happen to you 90% of the time. You know, you're excited about your deck, but you know, someone wants to go straight to the track record. I would say that, you know, what it was my main frustration when I started to raise money for emerging market funds was basically trying to understand who is allocating to emerging markets. There's still a big portion of LPs, either here or in Europe. Europe less so, but here in the US that won't do emerging markets.
How did you source that line of, shall we call it almost a pipeline or origination of potentiality in the LP universe?
Listen,
what did you use?
I think
a newspaper, go online. How did you find them?
Yeah, I think you have a few things that you have to do. Either you try to hire a placement agent that have some kind of idea, so you're outsourcing that effort to someone else, but you need to make sure that that placement agent understand that. Otherwise, that placement agent will be spinning the wheels as you're doing.
Right. Take the placement agent off the table. If it's just Aqua right now, how are you finding new LPs?
Well, I think by now, again, after 20 years, I have a notion of who's doing what. But Rob, even the LPs that were allocating to emerging market 10 years ago might not be doing that. And
it changes, yeah.
That happens. I mean, I had at least 5-6 conversations in the last 3 months with people that I have been speaking with for the last 10 years, and they are telling me I'm not doing LATAM for the next 5 years. Yeah, so unfortunately, a lot of this is trial and error. But I would say if you don't have a clear view of who is doing what, you are in for a lot of trial and error. And a lot of trial and error during the fundraising process is very costly. So another example, if you're trying to raise a $300 million fund, let's say first-time fund or second-time fund, CalPERS is not your LP, you know? That's the kind of things that you need to understand. I mean, the minimum ticket for those guys is 200 million. They won't do a fund that it's only fund 2. I mean, those basic things.
So do your research on the LP before you get kicked off. Yeah, that's a great point.
So your 300 million fund 2 needs to go more to endowments, foundations, smaller corporate pension plans and family offices. There's a lot, and I think this is really worth to talk about. There's a lot of LPs coming on the impact side, a lot of LPs coming on that sector. So if your fund you consider is impactful, ESG oriented, there's a bunch of new things that you need to know about.
Yeah, well, most of that stuff we'll be covering and putting into a perspective of each manager. I think Anderson, earlier on in the sessions, Kyle from MJ Hudson made it very clear that performance is not going to differentiate fund managers as much as it used to in the past, and I think the initial screening process involves that looking at track record to make it easy to say no quickly because they might have a benchmark. But if performance alone isn't really differentiating managers, what does on the qualitative side, and how does Redpoint put that part into its fundraising initiatives? How do you get that out there, the essence of the firm? How do you put that in the hands of LPs once you've established who they might be, you found the right LPs to be looking at, you're in touch with them? So if performance is not what they're necessarily looking to make specific decisions, what does? What is making them, and how does Redpoint put that into your campaign? How do you get it out there?
Yeah, my answer is going to have a load of bias here, Robert, from the stage that we operate in. So I think it's probably very different from stage to stage. But
focus on
for
that.
Us,
public like it. Yeah.
In the early stage, the most important thing by far and large is reputation, meaning your ability to attract deal flow, ideally proprietary. If it's not proprietary, if you have a fair chance to win the deal when it's a competitive bid, right? If there are multiple investors trying to come in. I think this professional LPs looking to invest in venture capital as a strategy, just to qualify it, because we have a lot of people learning and joining the market, they look at different things. But if you think about fund of funds that is selling to their LPs the ability to select managers, I think the most important thing is reputation, which translates in proprietary deal flow. The other thing is actually something I'm going to resell here, but actually I bought from you, Robert, a couple of years ago, which is consistency. So, and truly existing LPs, but especially new LPs, they compare a lot what you said you would do with what you actually delivered. So they look at your original pitch. I'm going to build a portfolio, 15 to 25 companies, mostly Series A, seed as an investment strategy. I'm pitching our pitch here, but seed strategy, not to make money on the equity, but as a construction of portfolio. And if we screw up, we might do Series B, either because we were too scared to commit or because we missed the deal because we were cheap. We don't use those words, but that's the strategy. So what they are going to do is look at the portfolio of Fund 1, portfolio of Fund 2. How does that compare to the pitch deck that you had? Did you do what you said you would be doing? Because for those professional managers, they want you to do the Series A because they have another guy doing the Series B, the other guy doing seed. So the consistency is what I think they look a lot as well. At least it's how we perceive it.
And staying consistent, sticking to your guns is one thing. Obviously, as you get larger or as you develop as a manager, you also expand your team and you might be expanding some of the verticals that you're willing to look at. That I think is understandable, but it's when there's a rapid shift away. Would you say that also works not just from the existing LPs, but also the ones that you're looking to captivate into the second or third fund? It's the same thing. They're looking at your details from the word go. So be very careful what you pitch and how you present yourselves from the start, and try and remember to stay true to that. Would you say that?
I think it's more important to the new ones. With the existing LPs, you end up building a relationship, right? So it's when you go pitch again, they are usually, depending on how you do it, but they might be knocking on your door for the next fund, or expecting you to come. They already know what you're doing. They have been through, different managers have different paces, but we report quarterly, have meetings quarterly. So they know how we think, they know how we behave, and so on and so forth. It's a lot easier. I think the scrutiny is much bigger for new LPs. And if you are in a firm that is expanding the same strategy, but bigger team and bigger fund, you're going to need new LPs. If you are going to expand into new strategies even more, I think you cannot do that and then let them know, right? You have to raise a separate fund or change your strategy before you deploy the capital.
Which also provides problems in terms of focus as well. You can have other LPs
focus conflict,
concerned that
right?
all of a sudden you have a real estate fund when you might have been doing VC. We did get a question coming in off the wires, and I think I'm going to push this over towards Gustavo because I know he from the placement agent side. Do you see any increasing movement from Asian capital investing in Latin America, or is it still basically concentrated in the US and Europe?
Yeah, I would say the short answer is no. I don't see that much Asian money coming into LATAM. I think it's a little bit on case by case basis, depending on the sector that you are. I mean, if you consider SoftBank Asian money, they are putting a lot of money in technology.
I was going to say that, that's just focusing on your segment, say middle market private equity players like Aqua. Would you say that so that your answer would be basically not so much right now?
Well, Aqua is a little bit different because we have, I think our sector is pretty strategic for Asia, which is ag and food. So we do have a few conversations with Asian LPs. Now, I think very connected to this point, Rob, is that we also need to understand that the Asian LP market is extremely diverse, right? So Japan is one thing, Korea is another thing, China is another thing,
and the Middle East
Southeast
is totally different
Asia
as well.
is another thing. So it's very, very, the one that thinks I'm going to go and do my Asia fundraising just like one block, it doesn't work.
It's not going to happen.
No.
It's the difficulties of the long distance and LPs wanting long periods of time to get to know you as well. Difficult as compared. Anderson, on the VC side, you'd probably say pretty much the same thing, or do you see a little bit more perhaps direct deals coming in on the VC side coming from Asia, perhaps a little bit more activity for VC funds and or direct deals, strategic investments from Asia, a little bit more in your field of VC?
We do see direct investing in later stage directly on the portfolio. And I think it's natural, at least in venture, some direct deals in the beginning, oddly enough. And then when they want to build a strategy, instead of learn about the region, they want to commit through multiple vintages. I think they will gravitate to the managers. We don't have any investors. We did talk to multiple, Middle East and Asia. I think it's more or less in the same bucket. So I think it's in the stage that they are building the relationships so that, in a couple of years, they will deploy capital. At least that's my gut. We do have peers that obviously we compare notes, and we do have, first tier VC funds in Brazil that already have LPs from Asia. Not a lot, right, but one here, one there, material.
Okay. Now, in terms of going the distance, being, we've heard over the period of this morning from placement agents, we've heard from strategic marketers who are looking to try and put together brand positioning and so on. As an additional element, perhaps it's a little bit more modern, it's moving forward, that might be more applicable to some of the deal by deal and also the smaller funds. But when we're starting to talk about the new digital platforms for fundraising, being to begin with crowdfunding, which I think is very nascent, very starting to get to look more on a deal by deal basis, but also in terms of online distribution platforms such as Palico and other groupings that. Anderson, from your perspective, have you worked with these? Do you see these as having any additional energy that can come into your campaign for your next fund? You see these as being logical next step partners, or have they basically failed to really impact you in terms of your own particular strategy for going to the international market?
We have not. I think they are still suffering from novelty crisis. So it's building up. Personally, as a technologist, I think it makes a ton of sense. If not for first closing of a new manager, that's probably tough. But if you're raising a $200 million fund and you have 150, you want to top up through one of those platforms, I think it makes a lot of sense already today or yesterday, so to speak. I think it's going to be a very important tool. It just makes sense with, in general, I wanted to do pilots with some of our funds. We talked to most of these guys. I think on both ends, both raising for the managers and as competition for us, or complementing fundraising for the founders on the crowdfunding side.
Yeah,
I think personal.
There's a differential there, which I think is important. When it comes to the actual target, the entrepreneurs, I think that's definitely a form, because it's smaller tickets, but I'm thinking more in terms of yourselves as fund. Let's focus on the fund management side of your business and putting together funds.
I think
Gustavo,
it will.
Gustavo, you see any new tools that, you're obviously coming from placement agent background, you've seen plenty. Do you see anything that is catching your interest a little bit, or is it still nascent?
We haven't used those platforms. I think you guys are right. I think it's very different to raise money with this platform for one specific deal that is very easier to DD compared to a blind pool fund. I still think that these platforms are missing that personal connection with the LP in terms of, the investment time decision for an LP can take 12 months to get to know a manager and commit to a blind pool of 10 years when you're locking your money. I think in Brazil, we're seeing a lot of new platforms coming, like the XP one, like the BTG ones. I mean, these are platforms that weren't in the market 5 years ago, and and I think they are providing something new in terms of the reach to the market, which, you know, with the Varejo and a bunch of other tools that you didn't have before. The question is, how many of the GPs can afford that? Because they are very expensive platforms.
No, well, I think most of the audience have been, are very well attuned to that level first, and that's why they're listening into us today to get a feel for the unknown, which is outside of Brazil for the international side. Yeah. Well, we're getting towards the end of the session. I'd like to grab from each of you just one final lesson learned through your journey, through your time, and through your multiple fund campaigns that you've worked through. One thing that you take with you and say, like, I learned this, and if I could go back and start all over again, I wouldn't have done this. Gustavo.
Yeah, you know, I think this is very, very straightforward, very simple. I think in fundraising, you're always feeling that you're behind, that you're late. So what I would say is that you don't want to be late, obviously, to a fundraising, but you don't want to be too early if you're not prepared. Right. Because managers do a lot of these mistakes. They go to the market too early, too unprepared, and then you are up for disappointment because LPs, for the most part, are unforgiving.
That's perfect. That's a great summary. Anderson.
Yeah, that's actually a very good one, Gustavo. But I'll try to come up with another one, which is do to your own LP base what you do to your portfolio. So diversify. I think this is general. It's truth in general, especially if you are a new manager or in an emerging market. I think it's critical. We raised our first fund fairly quickly and decided to, we wanted to raise between 80 and 100. I had a hard cap from the first investor at 130. We got there very fast and said, okay, you know what? Let's go to work. And then we raised from everybody else later. If I could go back, as you mentioned, Robert, I would, keep the fund open and keep raising for another 6 months and had a bunch of local investors in. Because churning from the investors that invested in Brazil as a mini China, when they say, "Whoops, what's going on here?" Geopolitics just went crazy. The crisis in Rio went down to the sugar loaf, to the hill. So that's I think it's diversification in the LP base is critical. I would have spent a lot more time doing that than anything else. And the other thing, it's in an emerging market, it's really hard to time the market. So I think the magic, if there is one, is time in the market. So be there all the time because, sometimes it's hard, sometimes it's easy. If you are only there during the hard times, you are screwed, basically. But
be there all the time. Those are great words of advice. Well, thank you, Anderson. Thank you, Gustavo. This really has been an incredibly concentrated series of dicas, ideas, and things that you can spend years learning the hard way. And I hope everyone's going to be able to pick up on that. I do remind everyone again that both Anderson and Gustavo are logged into the event, and they are willing to take meetings and talk and chat about their experiences in the past. Thank you both for offering that facility to us. The platform will be open for another couple of days, so do take advantage of this. This is really classic and great stuff. And so wrapping up on the overall conference, just want to say thank you for all the helpers and the providers for this, through Edgar and Gabriel over at, and Danilo over at SB Eventos. Thank you to all the speakers that we've had today, to Apex Brazil for sponsoring this through the Convenia program. Again, a very important part of the overall ecosystem that ABVCAP is very pleased to continue with this association with them. Thank you all for your time. Don't forget, of course, a very important part of this is to give us some feedback. with the evaluation on each segment if you can. This is really the critical part, so we can get some feedback from you. Say, look, I loved everything about this. I just didn't like the chairman of the event. That's great. You can do that as well. But just give us your feedback. Go through on the evaluation of the sessions, and this will make us even better for the next time we do this. And with the amount of good information we have, we really could do this on a regular basis. There's a tremendous amount of information. Go to the event platform, pick up the MJ Hudson and also the Prekin and Itajuba, all the details from these speakers' presentations from there. And we look forward to seeing you at our next ABVCAP event. Thank you very much.